Welcome to episode 38 of Fundraising Demystified. Today we have Alex Simpson, founder and CEO of OpenStock, a private stock liquidity lender for limited partners to access cash on their illiquid investments. If you manage a fund or invest in funds, this episode is for you. Alex is a repeat founder who discovered the need for LPs to have access to cash in a market where private companies stay private for longer. He has an $800 million fund backing him specifically to lend to LPs in private equity, private credit, and real estate funds. We talk about his experience catering to family offices and high net worth individuals, allowing them to amplify their investments through arbitrage and other investment strategies. Alex shares his advice to fund managers on how to manage LP expectations around liquidity and how OpenStock can be their partner to ease liquidity issues with their LPs. Alex is a sharp and tactful leader who is careful with his words and knows his audience. It was a pleasure having him on the show. And as a reminder, to get notified of our weekly podcast and newsletter, be sure to subscribe at join.thunder.vc. Again, that's join.thunder.vc. Now onto the show. Welcome back, everyone. Welcome to Fundraising Demystified. Today, we have Alex Simpson joining us, founder and CEO of OpenStock. Welcome to the show, Alex.
Thanks, Jason. Good to be here, man.
Now, I'm excited to have you share your story with the audience. Today, we're mixing things up a little bit. We're talking not just about your history with OpenStock, but also kind of the liquidity markets overall and kind of introducing our audience to this concept. So I'm really excited to have you on the show. It'd be great for you to give the audience a little bit more about you and your background and how that ultimately led you to launching OpenStock.
Sure. So pleasure to connect here. Originally from South Africa, been in the US for about 4.5 years. My background's been as a builder myself, as a co-founder, especially in the fintech space, B2B fintech. So over the last 12 years, started off from the mobile point of sale system space, going all the way to BNPL in the B2B space, and had a lot of experience in advising and growing some early stage fintech companies, very passionate about the space, which led to growing quite an expensive network in the pre-IPO and late stage private company space, and finding out quite a big need in private stock liquidity, which led to getting to lending. And then naturally that led to a much bigger need or a much bigger size of a market focused on LPs in traditional and late stage funds.
So let's unpack that for a lot of founders. We have a lot of early stage founders that, they're so focused on raising venture capital, but once your company gets to a certain scale and a certain size, there's this path towards generating liquidity as a private company. Since private companies stay private longer, raise more capital more privately, they're not going public. So founders, early shareholders, employees are not necessarily getting these big liquidity events and maybe are, trapped or, have some limitations. Can you kind of share a little bit more about what OpenStock is doing for this market?
Sure thing. So it is, just as a point of reference, it is only for a few companies. But for the general late stage companies that are pre-approved, we would focus on providing loans to the specific shareholders for them to do a range of things, from exercising options to focusing on outright liquidity to actually get some value or tangible value for the stock that they hold that isn't liquid at the stage. That's where we focus most. And especially as a company founder or a CEO, it's really important to incentivize your employees to get the right liquidity needed. And because the secondary market has a lot of variables in it, a lot of people would like to get short-term financing to maximize the upside component.
So this is interesting. So most people are probably familiar with secondaries. Hey, I early shareholder in ABC company, whatever, and you sell your shares. But the problem with that is you sell your shares, you have a taxable event, and you lose the upside. What you're providing is, basically liquidity, or you're collateralizing the options or the equity, and providing a loan for them to do as they see fit, whatever they might choose to do with the money, but you're kind of allowing them to continue to have that upside, correct?
That's correct, yeah. But our focus is more on the LP space right now, just where the secondary market is at this stage.
Interesting. So explain that a little bit more. So only LPs that have positions in these
In the
companies
funds,
and
yeah,
not?
not necessarily the companies. So we've shifted our focus primarily to focus on LPs or credible funds, late stage late stage funds from B to A grade, and that's where our primary focus is at the moment.
Ah, okay. So that's very interesting. So this is actually opening up liquidity for LPs, which
Correct.
has another big problem
Yeah.
in terms of just no liquidity happening in the last couple of years and needing to kind of meet capital calls, continue investing in other, asset classes. So that's essentially what you're focused on today.
Correct.
It's a good niche. I feel it's probably far less competitive than, some of the other categories that might be out there. Um, so you build this business, you identify this opportunity. How much capital do you raise to get this business off the ground?
So it was a mix of debt and equity. Currently, right now, we've got a fund behind us with 800 million focused on this asset class. The loans are quite sizable. So even though the amount is quite big from a fund perspective, the it's a very big market. So that is growing on that size, but that's sort of where we are today.
And from a fund perspective, so if I'm an LP in a fund and it's, kind of and are these VC funds or these private equity funds? What type of
Mainly
funds?
private equity and private credits. VC, we're a little bit reluctant based on the risk profile on the stage, but we can and have done many, but more primarily on the real estate, private equity, and private credit.
Gotcha. Okay, so yeah, those are a little bit more predictable, a little bit more stabilized than
Correct.
the volatility of venture capital. Okay, so we're getting a good grasp in terms of the need that you're feeling, and obviously you're in a much bigger market. Venture is a nascent, size in terms of the alternative markets. So you're tapping into a very very large market in terms of creating up and liquidity. So let's kind of unpack this a little bit more. You're a serial entrepreneur. You've built companies from before. You've identified this opportunity. You're releasing this out to LPs to create liquidity. What are you seeing in the market, right now for why this is such an important product to offer? Like, kind of what's your perspective on it?
It's just leverage. It's all about leverage at the moment. So to actually if you go into an investment and you see the upside in the future, even though the liquidity time frame may be a little bit longer than expected, a lot of people are still bullish on their investments. So instead of selling at a discount or even being able to sell it all, they could rather leverage that position, take a bit of an interest rate hit, and find an arbitrage, whether it be an alternative investment, whether it be for a personal need, whether it be from a tax efficiency perspective. There's a range of different use cases as they deem like most feasible or whatever is most financially advised. But that's sort of where the focus is, to give them that flexibility with the investments they've got.
And from being able to have this leverage and being able to have this as an option for LPs, with the markets being what they've been over the last few years, is this something that, is timely for now, or is this going to be something that's going to be, more and more pertinent? Or were there other solutions like this, but maybe not as accessible as you're making it?
Well, it depends on what the asset class is in the fund. A lot of banks offer this to their late stage, all the clients that they've got relationships with funds held by the bank themselves. Although this is a lot more fund agnostic and asset agnostic solution for a range of high net worths or respective different LPs and funds.
Gotcha. And how do you go about vetting and building these relationships with LPs, the funds? Like, kind of what's that process? How would, let's just say a large family office. Is it mostly family offices, or are you dealing with, institutional LPs? Like, who do
Small
you cater to?
institutions and family offices or high net worths.
Mhm.
So essentially we would work through them or work through directly through the fund.
Gotcha. So you're building these relationships, and so you build the relationship predominantly with the fund or with the LP when you kind of go about,
It's a mix.
creating access.
Yeah, it's definitely a mix. There's a lot of referrals that come from LP to LP or directly with the fund who refers us to the LPs based on their liquidity needs.
Gotcha. And from the looking at the different asset classes, across the board, where are you seeing liquidity kind of get tighter and less accessible? Because, we hear about the markets in terms of commercial real estate and what's been happening in that over the last couple of years as, work from homes have become more popular. Kind of what's been your what's been your insights in terms into the market in terms of these alternative asset classes?
I'd say the insights, it's mainly, it's not necessarily on like the fund, it's more on the use of funds. So there's a lot of people that have got timely events from maybe a tax perspective. They need to pay a certain tax bill, or they go through personal events such as divorce, or they have an opportunity gain where there's the opportunity cost of not having enough capital to deploy on a specific investment at a certain time. That's when they need as much liquidity as possible to open up that opportunity. So it's really dependent on the use of funds and the time.
Well, I guess going back like from the asset class of it doesn't matter really what asset class you're underwriting in terms of the fund, like if it's a real estate fund or a private credit fund.
Correct.
It's more of underwriting the time of like that they'll need access to this capital. Are you looking at like 6-month type terms? Are you looking at 5-year type terms? And I guess what are some of the unit economics of these loans for family offices or high net worth individuals?
Sure. So, I mean, that would flex roughly between a 25 to 30% LTV. And we do a 6 to 60 month term. So, roughly 6 months to 5 years.
And so basically, like if I'm a family office, I have my position and my cost of capital, call it, I don't know if you guys are Prime Plus or anything of that sort. Is that kind of similar, in terms of pricing for interest rate, or are you guys subprime?
Yeah, it'll all depend on the underwriting. We'll give a quote based on that.
So it can range depending on who the lender is, who's
the borrower.
Who's the borrower, yeah.
Correct.
So it could be an arbitrage game for them, or tax benefit. But if they have the opportunity to participate in something that has a larger upside, it's worth the cost of capital to take out this loan, take out this interest. So similar to margin trading for the average retail trader who whatever has a couple $100,000 in a margin account, they could basically amplify that account, but at the cost of that interest. So they're making bets that have a higher yield than whatever they're paying on that margin interest.
Correct.
Gotcha. So it's just creating a lot more accessibility, but for the private markets more so than what's already accessible in the public markets, because it's a lot easier to underwrite the public markets.
Yeah.
Gotcha. So when you look at who you get to work with and the opportunities that you're creating, like what kind of excites you most about this market and working in this field?
I think it's just how investors think about their money at specific times in their life. So to have a retrospective look at how some investors have planned out their life and what they do from a funding perspective and what they need the funds for, it's very interesting to see where you can help them from a liquidity perspective and how they see leverage as less of a risk but more of a utility. I think that's pretty interesting. So yeah, and I think it really comes down, especially in markets like this, where from a realism perspective, you can see which funds are paying out true liquidity and dividends, and which are truly long term. And you can see which kind of investors went in there with the true conviction to hold their money for the longer term. And the types of investors that just get inundated with a bunch of opportunities that just don't have enough liquidity to supply and are simply looking for the ability to make more good decisions. So there's a lot of people that we've focused on providing liquidity to, and we've seen that they just had really good luck or really good track record of investments, and all they want to do is open up the ability to do more, and that's what we're enabling them to do.
And obviously, anonymized, but what are some examples of some interesting deals that you've been able to facilitate due to you opening up access to liquidity to these LPs? Like, what are some interesting, like you kind of mentioned high level, but anonymize as much as you want, but like what's an interesting like kind of outcome that you enabled?
I think one of the most interesting ones was just how a specific investor would utilize that leverage in order to reinvest it in another leverage and another opportunity that provided a high yield. So for instance, if they were to lend it, let's just say 10% per annum, and they were to find a yield for a different type of asset class that provided 16%, they've used our money to make 6% net within a year. So I think that was quite interesting to see how it's used in certain times to seize an opportunity and actually make a profit.
Gotcha. So simple kind of interest arbitrage opportunities, and being able to capture that spread off what essentially is free money,
because they're amplifying they're kind of, well, I guess they're not really reducing their cost basis. Their cost basis is staying the same, but they're amplifying the impact that it has. They're earning an additional 6% on their cost basis that is lower than what it would have been if they had to deploy new liquidity into that deal. Because 6% on, your original base, whatever, $1 million is, okay. But if you have $1 million working and making you whatever 15%, and then you're able to take out another 250 and earn 6% on top of that 250 at no additional cost, and obviously minimal risk. Obviously you're over leveraging, not over, but extending yourself and hopefully going into safe investments. But I guess what kind of return profiles do you see for LPs in this space? Like you kind of mentioned the 16%, in the private credit markets, what kind of return profiles are you seeing LPs capture right now with interest rates as high as they are?
I mean, a yield between 14 to 18%. They're looking for like mid to late teens in terms of interest rate. Like that's sort of where they'd look for. But I mean, it all depends on like the underlying asset class. So it really does depend. Like, I don't have like an exact answer for that, but yeah, we're not doing any private credit, so we're doing across the board. But we know what ours are, so that's where we focused.
So some deals producing 14, 18 at a high level. Do you see, is that net of fees or is that before fees?
Net.
So phenomenal. Those are,
they can get high, yeah.
And private credit being collateralized, so some, depending on the the fund, how they run, there's a little bit minimized risk in that as opposed to equity investment. So 14 to 18 is an incredible opportunity to be a part of. Do you see those types of returns accessible to smaller investors, retail investors, or like kind of more like a high net worth individual, but maybe not a family office scale?
I don't know, to be honest. I don't know what platform could access those returns at the moment. I'd be curious to know which, but I don't know the answer.
Yeah, my understanding is no. That would be my understanding is, those typically are reserved for larger funds, larger amount of capital being deployed at scale with, top tier managers, at least from my experience.
Yeah.
And do you see any of your transactions or anything being allocated to the more riskier asset classes in terms of crypto or any other types of, they take this leverage and put it into any other asset class that maybe not stabilized as private credit or real estate? And would you underwrite something like that?
So first part of the question, we don't restrict the use of funds. They can use it for whatever they deem fit. So I'm not too sure what the end uses were of some of the transactions, but I'm sure that they may have fallen within these brackets. I'm not sure. And we tend to stay away from a bit of these high risk assets at this stage. So focus more on conservative, more traditional type funds.
Gotcha. And for funds that are out there, whether there are, like I said, any type of the asset classes that we've mentioned earlier, like which of these fund managers know if they're a GP, they have LPs kind of knocking on their door saying like, when am I going to get my returns? When are you going to start to, putting out distributions? Like, how do you work? Like, kind of walk us through how you help those GPs alleviate that stress in terms of connecting them to the LPs.
Sure. So we would simply go in an agreement to get the consent of the GP. We would underwrite the fund, and from there, they could communicate, or we could connect directly to the LPs based on the valuation that we deem fits in the fund, and then we could provide loans based on a standardized term.
And funds have their own way of marking up their assets and underwriting their themselves and kind of whatever their assets under management or whatever the fund size is, fund value. Like, do you come in and do a completely independent audit of their assets? Got it.
We go through an underwriting process, but we do come up with our own term.
Did you know that most founders waste days of their lives chasing the wrong investors? Well, as a founder, your time is your most valuable resource. Don't waste it on the investors that aren't going to write you a check. Here at Thunder, we built a free tool that identifies exactly which VCs are worth your time to pursue. We score your company against 3,500 VCs and family offices that have been vetted and are actively writing checks into companies like yours. Get your AI recommended list of investors that will look like this absolutely free by creating a free profile at Thunder.vc. You can upgrade to premium to download this list, export it to any tool you wish, and get their contact information and access the data on their portfolio companies to map out a path to warm intros and build your founder network. Sign up for free at Thunder.vc. Now let's get back to the show.
Got it. What's kind of the disparity that you would see between what they claim is their net asset value versus what you underwrite? Do you see a giant disparity often, or is it usually aligned?
Not giant. I mean, it's variable, but yeah, depending on the asset class, of course, VC, there would be a bit of a disparity, but it really depends on after the underwriting. There's no standard answer for that.
Yeah, I guess the only reason I asked is just because and VC not necessarily being your main focus, but I see VC being that, that's a bigger problem, just the difficulty of underwriting those assets. And going off like last round, type valuations might not always be the most relevant way to underwrite these deals, especially as we look at the recent Bolt deal where I think Ryan Breslow had the company valued at $11 billion in 2021, had everyone lever up and buy, exercise their options, and now the company is just recently valued at $300 million. Quite the 97, there's like a 98% devaluing of the company. Did you hear about that?
I did. Yeah, I did.
Yeah. So what's kind of your take? Like, how do those types of things happen in your opinion?
Well, it's a private company. We didn't work with them, so I can't comment on that particular circumstance. Yeah, it is just what it is. I don't know how to answer that.
Fair enough. Yeah, it's definitely been an interesting saga to kind of see unfold and see how that's impacting both, the employees as well as GPs that have raised deployed capital into that company, as well as, obviously the LPs thinking they had massive markups and, this amazing TVPI numbers, and then ultimately not seeing those, come to fruition. So given your experience as an operator in the past, and, building companies, raising money, how did that ultimately help shape your perspective of doing what you do today?
Yeah, I think like quite a few different aspects. I think like if you don't raise the right VC money or the right funding money, it's more of like debt as opposed to equity unless they're value accretive, because the money needs to go back in some stage or form. I think product market fit's critical. I think really just being real about that product market fit up front is crucially important. I think I think also just being aware of what can be a feature as opposed to a business is really important, even from the B2B or the B2C space. I've seen a lot of deal flow with people. They've got a very unique idea, even at the event that we were earlier. But there's a lot of larger companies that you could just pick up, could either turn this on as a feature if they see it, the market size growing rapidly, as opposed to just assuming that, we could white label to that company. I think, I don't know that there's not a standardized checklist. I just think it's now more intuitive after all these years. When you go into something, when you're going through something, it's like a seventh sense. You just pick up certain things. But the best thing is just getting your head hit and just diving in. Being as prudent as possible. I really think getting perspectives from players in the space, even speaking to competitors that are bigger than you in the beginning, like being a little bit more vulnerable, not trying to divulge any information, but both ways, but just being open, getting thoughts. I think that's pretty, I think those are the high level things. I mean, it's a long list, but
No, I think it's interesting you mentioned the idea of like talking to the bigger players. I think a lot of founders struggle with the idea of, they're going to steal my ideas, or if I talk to people, they're going to, take my vision away from me, or things along those lines. And, you're coming out and saying like, no, it could be advantageous to have the chat and share your ideas and revise and evolve the concept of the business. What do you say to founders that are afraid of having their ideas stolen by having those conversations?
Well, I wouldn't recommend going direct every time to a competitor. It depends what it depends on the idea, but I think if you can expose yourself to potential competitors that, would either build a solution or just get their thoughts in the space, without trying to like provoke too much IP. It's a tender discussion. It depends on the person. It depends on how you handle it. You can go up front and just say, hey, I'm building in the space, building a very similar business to you. What have you learned? Do you think the space for competitors? Could we help each other? It really depends. I don't have the right answer. My gut instinct is to like speak, be a bit more open, see how you can collaborate. It all depends on that.
Yeah, I'm more in your camp. Share and be transparent and learn and evolve. The more you talk about it, the more you pitch it, the more you put it out there, the more refined it becomes and the more relevant it becomes. Because when you kind of work it in your head over and over again, but don't actually like put it out in the world, you might be missing valuable points of input data that can refine the idea and make it a more relevant opportunity.
And also regulation. I mean, like that's something that like people really undermine. Just it could be with rates, it could be with user laws, customers. I think it's just really good to be aware of that space. Like there could be certain regions where your product is feasible to enter and grow. There could be some where it's a lot more restrictive. Like I'm not in crypto, but I see that like, crypto is very regulated in the USA. So there's other regions that are more feasible. So from like a regulatory perspective of the landscape, that's crucial as well.
Like when you were conceptualizing OpenStock and you come from a background of building companies and you're seeing this opportunity, like how long did it for you, what was that process like in terms of getting the idea that you had and kind of getting it to the point where you work with an $800 million, hedge fund to that scale and to facilitate these level of transactions? That's not something that usually happens overnight. Like what was that experience like kind of getting, from it's an idea in your head to, transacting?
100%. Yeah, but the initial idea wasn't novice at all. There were quite a few larger private lenders doing this in small chunks or ad hoc basis to clients that had relationships with for over years. So if you could do this at a more scalable perspective, there could be more benefits. But as the markets changed, volatility changed, valuations, etc. So it's all a learning perspective overall.
Did any kind of incumbents push back on what you were trying to do, or did you get any friction from target customers on your approach or how you're doing it?
Yeah, 1,000%.
What was that like? What was that experience like?
You got to just keep the relationship and you got to be respectful and keep trying with others. It's the only thing you can really do.
Fair enough. So what would be some parting advice for colleague GPs that are, growing their fund, deploying their fund, working on what they're doing, and having an issue with either LPs or, what would be your parting advice to GPs on this front?
I'd say, managing expectations with your LPs as to whether they're going to be value add or whether they're going to be passive is very important from the get-go. Understanding their potential liquidity constraints or liquidity requirements over time is important, whether it be from secondaries, lending, certain things like that. I think it's just important to understand what they see this investment as. Some people just see it as a favor. Some people see it as, there could be multiple reasons, but I think just getting an understanding post-transaction, because you don't want to deter your LPs, is just understanding why did they invest. I think that will be quite good. Indirectly to promote our product, we provide the alternative liquidity. That's just something we're just an option. There's no liability to them, but it's always something great to point out. It would be a pleasure to work with more GPs. But that's what I can say. I haven't owned and operated a large fund myself. I think everyone goes through their own journey, from emerging managers based on the sector, based on the type of LPs they've got, especially institutional to post-exit founders, etc. So it'll be very difficult for me to give like a unified answer, but I think just getting just managing communications and managing expectations with your respective investors, and always just asking for like from a growth perspective, whether it's further LPs or distribution potential for the portcos you invested in. I think that's really critical. I think every fund needs that advantage, but I think every fund's got their own unique formula. But that's the general advice from my perspective I can give.
You bring up an interesting point. It sounds like common sense, but I think in practice it's a lot harder, or not as often talked about, especially on the venture side, is kind of why is that LP investing and what their expectations are in terms of returns. Because, large LPs, they're not just investing in a fund, they're investing in dozens, if not hundreds of funds, in terms of diversification and deploying capital. And with that, and all the different asset classes, they have to have this portfolio construction. We have these capital commitments at these times to, stay consistent with either, in participating in the next fund of a trusted manager, or, they need to meet certain obligations. And as a GP, knowing kind of what that schedule looks like and knowing your LPs well enough to know when and how you will deliver, distributions or returns is something that, at least me not being a GP and not hearing these conversations often, it sounds something that's actually pretty important for GPs to really understand and document properly, so that they know if they're expected to deliver distributions at a certain date or on a certain time schedule, that LP might be relying on it. And if they don't deliver, something like OpenStock can come in and kind of fill that void to make sure that, the engines keep moving, the cash keeps flowing. So, well, Alex, I appreciate you being on the show. Any last minute advice or anything that you would like to share for the audience to know more about, what you're up to at OpenStock?
Yeah, sure. From the fund, I mean, very happy to connect with any GP or LP. I don't want to overpromise any expectations, because we have to get comfortable with the fund, etc. After the underwriting, so we only take in about 10% of the funds that we interview, but very happy to communicate regardless and go through the process just to issue terms if it's feasible. Yeah, I think from a business perspective, like that's it. From a personal perspective, the only advice I can just share is just like, don't believe in narratives with anything. I think when it comes to business or relationships or people, I think like just don't build up this narrative in your mind based on the individual's background or the fund's background or news, etc. I think like just go in with like an open mind and an open heart into like engagements, whether it be competitors, sales, etc. I think just kind of like listen more and then make a decision based on that and previous learnings.
Interesting. You say don't buy the narrative.
Don't build a narrative. Something I was very guilty of moving to this country from South Africa, and you build all these preconceived narratives of people and their backgrounds and the funds, and then there's always a mismanagement of expectations, and especially when you get disappointed with others, it's mainly just a fact of you being at fault because you put an expectation or a narrative at bay. So I think that's just more of like a personal learning I've taken. So yeah,
that's actually some really good parting advice. I appreciate you sharing that. I think that is very much a real concern or problem that exists in terms of what leads to mismanaged expectations. And actually, I was going to wrap on that, but you opened up something I thought I would unpack a little bit more. So you only work with about 10% of the funds that you underwrite.
100%. We can't do it to any, because at the end of the day, if the fund doesn't go, we have to have a good book. That's very critical. We're very prudent with our investments. We're very prudent with the loans we make. So yeah, it's crucial that our book stays clean, even though the funds to be credible. And just because a reputable fund has invested alongside a particular LP, etc., doesn't mean that the business or the particular portfolio will do well. So we have to be extremely prudent with the underwriting process to ensure we mitigate risk.
So I know that every fund's different, but just like, what are some of the common attributes of a fund that passes the cut?
It's pretty nice. So we've got over like 200 data points that we look at. So I can't go through the whole list now. But it just general performance. I mean, it's more quantitative than qualitative. But you have to look at it from like a PE or growth stage investment lens, because essentially if you're lending against a portfolio or a particular fund, similar to making an investment from an equity perspective. So you have to have the same underwriting investment thesis that a fund that could be buying that secondary position out as well. So it's very complementary from an LP buying position.
Gotcha. No, that's super valuable insight, and I imagine that top 10% of funds and who those are amazing funds to be working with, and I'm sure attract lots of capital and lots of options. So with that, Alex, I really appreciate you coming on.
Thank you. Appreciate it.
Opening up our minds to this other side of the transaction and the fund world and capital worlds. So appreciate you sharing your insights and sharing your background. So thanks for being on the show, Alex.
Thank you, Jason. Appreciate it.
Thanks for listening to the show today. We hope you learned something valuable. And if you did, be sure to let us know in the comments or by hitting that like button. And if you're a founder looking to raise capital, then join us at Thunder.vc. We provide a free tool to help you identify which VC, family offices, or lenders are the best fit for you using our AI. It will save you a ton of time from chasing the wrong investors. And since launching our free tools, founders that have joined our network have gone on to raise over $1 billion in financing. Again, you can find these free tools at Thunder.vc. And as a reminder, we release new episodes every week, so stay informed by subscribing to our newsletter at join.thunder.vc. Again, that's join.thunder.vc. And if you or someone you know has recently raised a round and want to share your story, please email me at jason@thunder.vc. And that's our show. We hope you enjoyed it, and we see you next week.